Hey everybody, Dr. Phil here. So this is going to be a video on return risk and the securities market line, what we call the SML. So let's start with a brief discussion on expected return. So consider a single period of time, just say like a year. Let's say we have two stocks, right? L and W, which have the following characteristics. So stock L is expected to have a return of 25% in the coming year. That would be a good one to get. And stock U is expected to have a return of 20% for the same period. So both pretty good. Now, there are two states of the economy, which means that there are only two possible situations, and the two are equally likely to occur. So the first state is the economy booms, in which case stock L will have a 70% return and stock U will have a 10% return. The second state is economy enters a recession, where stock L will have a negative 20% return and stock U will have a 30% return. So you can kind of see down here the probability of this state, 0.5, 0.5, because I said they were equally likely to occur. That gives us the 1.0. And then if there's a recession, negative 20 and 30. And then, of course, if there's a boom, 70 and 10. So the expected return is the return on a risky asset expected in the future. So the expected return on stock U is 20%, which is found by, so we just take the 0.5 times the 30 plus the 0.5 times the 10. You could actually put parentheses around like before the 0.5, after the 30%, and then again before the 0.5, and then after the 10%. Do the same down here for stock L as well. And you get 20%. Do the same thing for stock L, and you get the 25%. So we're just kind of showing that the 20% and the 25% has some sort of, mathematical grounding, if you will. So the following table illustrates these calculations. So you can see down here, we've got the recession, boom. We said it was an equal chance, so the 0.5, 0.5, right, 50-50. And then we've got the negative 0.2, and then we've got the negative 0.1, which of course is just 2.5 times 0.2. And then same here, 0.35 is just 0.5 times 0.7. And then the rate of return, if the state occurs, we've got the 0.3, and we've got the 0.1, and then we've just got the product. So we just multiply those out, right? So the 0.15, 2 times the 0.5 times the 0.3 is the 0.15, 0.5 times the 0.10 is the 0.05. So using projected returns, we can calculate the projected or expected risk premium as the difference between the expected return on a risky investment and the certain return on a risk-free investment. Suppose risk-free investments are currently offering 8%, which we'd call the risk-free rate, which we label as R sub F, and that's 8%. Given this, what is the projected risk premium on stock U or on stock L? So the expected return on stock U is 20%, and the projected risk premium is, so we can just use the formula, plug in your numbers, 20% minus the 8%, so the risk premium, of course, is the difference, right? It's like over and above the 8%, and that's 12%. So the risk premium on stock L is 25% minus the 8%, which of course is 17%. So in general, the expected return on a security or other asset is equal to the sum of the possible returns multiplied by their probabilities, what we call states of nature. So looking again at those tables, suppose you think a boom will occur only 20% of the time instead of 50%. What are the expected returns on stocks U and L in this case? If the risk-free rate is 10%, what are the risk premiums? So the first thing to notice is that a recession must occur 80% of the time because they said the boom would now only be 20%. So because there's only two possibilities, right? Recession or boom. With this in mind, we see that stock U has a 30% return in 80% of the years and a 10% return in the remaining 20% of the years. So to calculate the expected return, we again just multiply the possibilities by the probabilities and then just add up the results. So here we can say the expected return in stock U is the 0.8 times 30%, and then plus the 0.2 times the 10%, and we get 26%. Table 13.3, we're going to summarize the calculations for both the stocks. Notice that the expected return on L has now gone to negative 2%. Okay, so you can see that here, the negative 2% versus the 26% for stock U. So the risk premium for stock U is the 26%, minus the 10% risk-free, which is 16%. And then the risk premium for stock L is the negative 2 minus the 10%, which of course now is negative 12%. All right, let's now talk about calculating the variance. So let's return to stock U, which has an expected return of 20%. In a given year, it will actually return either 30% or 10%. So the possible deviations are the 30% minus the 20%, which of course is 10%, and the 10% minus the 20%, which of course gives us that negative 10%. So in this case, the variance is, so here's what we're going to do. We're going to take the zero point 0.5 times the 0.10 squared plus the zero point 0.5 times, in parentheses, minus the 0.10 squared, and we get the variance as 0.01. So the standard deviation is just always the square root of the variance, so that would just be 0.1, so we could just say it's 10%. And you can see below, we've got stock L and stock U. The expected return, 25% versus 20% for L and U respectively. The variance is 0.2025 for stock L, and the calculated variance for stock U is 0.01. And then, of course, the standard deviation, which is just always the square root. So 45% for stock L and 10% for stock U. So what we know here is that stock L is has a lot more volatility, if you will, as that standard deviation is considerably higher for stock L than it is for stock U. All right, so this is a term you may have heard of before, portfolios. So a portfolio is a group of assets such as stocks and bonds held by an investor. The portfolio weights are percentages of a portfolio's total value invested in a particular asset. So if we have like 50 bucks in one asset and we have 150 in another, then of course we add those together. Our total portfolio is worth 200 bucks. The percentage of our portfolio in the first asset is just the 50 over the 200, so of course 25%, right? And then we have 75% in the other asset. So we'd say the portfolio weights are 0.25 and 0.75. So let's go back to stocks L and U. So let's say that you put half of your money in each. So what is the pattern of returns in this portfolio? And what is the expected return? So suppose the economy enters a recession, in which case half your money, the half you had in L, loses 20%, and the other half, the half you had in U, is now going to gain 30%. So in a recession, the portfolio return is 0.5 times negative 20. Think about the negative 20 from here, losing 20%, plus the 0.5 times 30%, because stock U gained 30%, and that gives us 5%. So the portfolio return is 5%. If we have a boom, the portfolio return is 0.5 times 70%, plus the 0.5 times 10% for stock L and U respectively. So in a boom, the portfolio return is, in a boom, it's 40%. Thus, the expected return on your portfolio, if we weight it out, is 22.5%. We can calculate the expected return more directly. We can just use this formula. So just plug in your 0.5, it's 0.5 for either one, right? Times 25% plus 0.5 times 20%. And this is where we get the 22.5. So think of the 22.5 as like halfway between the 20% and the 25%. Now, if we have n number of assets in our portfolio, where n is any number, and xi stands for the percentage of our money in in asset I, then we have a formula that we can use here for expected return. So let's say we have the following projections for three stocks. So we have the state of the economy, boom or bust. We have the probability, 0.4 or 0.6. Returns if state occurs for stock A, 10%, 8% for the bust. Return if stock occurs for stock B, 15 and 4. And then the return if the state occurs for stock C is 20 and 0. So we want to calculate the portfolio expected returns in two cases. First, what would be the expected return with a portfolio with equal amounts invested in each of the three stocks? Secondly, what would be the expected return if half of the portfolio were in A, with the remainder equally divided between B and C? Based on what we've learned from our earlier discussions, we can determine that the expected returns on the individual stocks are, let's get to it, 8.8%. The way to do this, just go back and plug the numbers into, let me go back, into your formula here. 8.8% for stock A, 8.4% for stock B, and then 8% exactly for stock C. Now, if a portfolio has equal investments in each asset, the portfolio weights are all the same. So then we would say the portfolio is equally weighted, right? Because there are three stocks in this case, the weights are all equal to 1/3. The portfolio expected return is just 1/3 times the 8.8 plus 1/3 times the 8.4. Probably see where this is going, right? And then 1/3 times the 8%. So we get a median of 8.4%. So in this case, verify that the portfolio expected return is 8.5%. All right, what about expected and unexpected returns? It probably sounds a little like, a little weird because you can't expect the unexpected, right? But let's talk a little bit about this. So consider the return on the stock of a company called Flyers. What will determine this stock's return in, say, the coming year? Return on stock traded in the financial market is really made up of two parts. So we have the normal or the expected return from the stock is the part of the return that shareholders in the market predict or expect. And then number two, the uncertain or risky part is the portion that comes from unexpected information revealed within the year. So the return on the Flyers stock in the coming year would be the total return is just simply the expected return plus the unexpected return, where R stands for the actual total return in the year, ER stands for the expected return, and then U stands for the unexpected part. So there's different terms we can use for this. We could say systematic risk. So that's what we call like the risk that's just like inherent in the market. This is going to influence many assets. So for example, things like GDP fluctuations, interest rate changes, inflation, right, general economic conditions, wars, rumors of wars, so on and so forth. And we can kind of compare that and indeed contrast that to unsystematic risk. So that is the unique or the asset specific risk. So that's a risk that affects at most a small number of assets. So for example, the announcement of an oil strike by a company doesn't affect the whole market, but it does affect certain assets within that market. So the actual return broken down into its expected and surprise components is just simply R equals like we said, the expected plus the unexpected. The total surprise component has systematic and unsystematic components. So we would say R equals ER plus the systematic and the unsystematic portion. So we're just taking U, the unknown, and we're just kind of breaking it out into the systematic and unsystematic parts. So we can rewrite the formula for the total return, allowing the sort of this funny looking E thing here, looks a little bit like a pound sterling symbol, to stand for the unsystematic portion, and then M to stand for the systematic part. So we're substituting U and we're just replacing it with M and E. Now, some of the risk associated with individual assets can be diversified away and some cannot. So why is this the case? Why is this so? Well, if we held only a single stock, the value of our investment would fluctuate because of company specific events, right? If we hold a large portfolio, some of the stocks in the portfolio will go up in value because of positive company specific events, and some will go down in value because of negative events. So the net effect on the overall value of the portfolio is going to be pretty small because what will typically happen is they'll just cancel each other out. Now, when we combine assets into portfolios, the unique or unsystematic events, both positive and negative, will, like you say, tend to kind of wash out because we have more than a few. And if you only have a few assets, you're not really going to see that. But the more assets you have, the more they'll kind of like just kind of offset each other. So another way we could say this, and I put this in bold at the bottom here, is unsystematic risk is essentially eliminated by diversification. So a portfolio with many assets has almost no unsystematic risk. So think of this as the more assets, different types of assets you have in your portfolio, the less the unsystematic risk is going to be. Now, if unsystematic risk can be eliminated by diversification, is the same true for systematic risk? And the answer is actually no, because this type of risk affects almost all assets to some degree. So no matter how many assets we put into a portfolio, the systematic risk doesn't go away. The total risk of an investment, as measured by the standard deviation of its return, can be written as, we remember this from before, right? Total risk equals systematic risk plus unsystematic risk. So the systematic risk is what we call the non-diversifiable risk, because you're not able to diversify that away and lower that risk. Or you can just call it the market risk. The unsystematic risk is also called diversifiable risk, unique risk, or asset-specific risk. Now here, what we're saying is we can diversify that away by broadening out our asset base, if you will. So the systematic risk principle states the expected return on a risky asset depends only on that asset's systematic risk. So only the systematic portion of total risk is relevant in determining the expected return and indeed the risk premium on that asset. So level of systematic risk is measured using what we call the beta coefficient. So an average asset has a beta of 1.0. That's always going to be the case. You can take that to the bank, no pun intended. An asset with a beta of 0.5 has about half as much systematic risk as an average asset. And then, of course, an asset with a beta of 2 has twice as much. So there's some examples we've included here for you. So like Coca-Cola is about half, McDonald's a little more than that, and then all the way down to Visa, we're kind of below the beta, if you will, with respect to systematic risk. And then MasterCard, Walt Disney, Sherwin-Williams, and Shopify, these all have higher than one beta coefficients, indicating a higher level of systematic risk than beta. All right, consider the following information about two securities. Which has greater total risk? And then which has greater systematic risk, greater unsystematic risk, and which asset will have a higher risk premium? So we got the two securities here. Security A, 40% standard deviation with a 0.5 beta, and then security B with a 20% standard deviation. But look at the beta there, triple um, the security A beta at 1.5. So from our discussion in this section, security A has greater total risk, but it has substantially less systematic risk, right? Look at that 0.5. Because total risk is the sum of systematic and unsystematic risk, security A must have greater unsystematic risk. So finally, from the systematic risk principle, security B will have a higher risk premium and a greater expected return, despite the fact that it has less total risk. Because the security B, like security A, you could mix this up, diversify a lot of this away. Security B, it's going to be very hard for you to do that. All right, you probably heard the expression buy low, sell high. So we would generally postulate that an asset is said to be overvalued if its price is too high given its expected return and risk. Suppose you observe the following situation, right? So we got these two companies here, SWMS company and INSEC company. We've got betas of 1.3 and 0.8 respectively, and we have expected returns of 14% and 10% respectively. Now the risk-free rate is currently 6%. Is one of the two securities overvalued relative to the other? So there is the question. So to answer, the first thing we're going to do is compute the risk to reward ratio for both. So for SWMS, the first company, just the 14% minus the 6% risk-free, and then just divided by the 1.3 by the beta, we got 6.15%. For INSEC, if we perform the same calculation on INSEC, then we get 5%. So what we conclude is that INSEC offers an insufficient expected return for its level of risk, at least relative to the other company, SWMS. Now, because its expected return is too low, its price is thus too high. So in other words, INSEC is overvalued relative to SWMS. And what we would expect to see is the price fall, again, relative to SWMS. So another way we could say that is we could say SWMS is undervalued if we want to talk reciprocally relative to INSEC. So INSEC is kind of like overvalued, and then we could say SWMS is undervalued. All right, the securities market line, the SML. This may be something you've heard of. It's okay if you haven't. The securities market line is a positively sloped straight line displaying the relationship between expected return and beta. Suppose we consider a portfolio made up of all the assets in the market. That is, we'd call that a market portfolio. Makes sense, right? With the expected return on this market portfolio denoted as E, and then in parentheses R sub M, close parentheses. Because all the assets in the market must plot on the SML, so must the market portfolio made up of those assets. Now, because the market portfolio is representative of all assets in the market, it must have average systematic risk, that is, a beta of 1. So we could express the slope of the SML securities market line as follows, right? So we've got E, RM minus, this is, remember, RF is the risk-free rate of return, and then over the beta, and then for the next one, and this would just keep going for all the extra, all the extra assets we added in. So the market risk premium is thus the slope of the SML, the term E, RM minus, and then R, and then if you notice, they put the little subscript, RF, the risk-free rate. Okay, something else I wanted to make sure we just touched on in this video was what we call CAPM, Capital Asset Pricing Model. So CAPM is the equation of the SML showing the relationship between expected return and beta. So if we let E parentheses R sub I and B is just beta sub I stand for the expected return and beta respectively on any asset in the market, and the following equation is the CAPM. So CAPM shows the expected return for a particular asset depends on really three things. So the pure time value of money, as measured by the risk-free rate, that's the R sub F you see here. This is the reward for waiting on your money without taking any risk. Number two, reward for bearing systematic risk. As measured by the market risk premium, E parentheses RM minus R sub F, this is the reward offered for bearing an average amount of systematic risk in addition to weighting. And then number three, the amount of systematic risk as measured by B sub I. This is the amount of systematic risk present in a particular asset or portfolio relative to that in an average asset. So here you see kind of the capital asset pricing model line. So this is, you can see this green line moving up, right? So the slope of this line is equal to the market risk premium. So that is the reward for bearing an average amount of systematic risk. So the equation describing the SML can be written, and then you see the equation at the bottom there, which of course is what? That's the capital asset pricing model. All right, risk and return. Hopefully a term you've heard of before. Certainly will if you start investing money. The premise here is very simple. The more risk you take on, the more return you should expect, or you should hope to expect. So let's suppose the risk-free rate is 4%, the market risk premium is 8.6%, and a particular stock has a beta of 1.3. Based on the CAPM, again, capital asset pricing model, don't forget what that stands for, what is the expected return on this stock? What would the expected return be if the beta were to double? So with a beta of 1.3, the risk premium for the stock is just simply 1.3 times the 8.6%, or 11.18%. The risk-free rate is 4%, so the expected return is 15.18%. If the beta were to double to 2.6, the risk premium would double, or of course also double to 22.36%. So the expected return would be 26.36. So what they're trying to show you here is actually pretty simple. That is, when you're comparing things relative to beta, the higher the risk, then the higher the expected return should be. Keep that in mind as you invest money in really anything: stocks, bonds, foreign exchange, real estate, whatever, tokenizing stuff, whatever it may be. Make sure that you understand that if you're being asked as an investor to take more risk, then the compensation that you're getting for that in terms of the return should also be higher. All right, thanks for watching this video, and I will see you soon in another video. Take